Ladies and gentlemen, we are now about to move on to another finance dialogue. We're about to quickly set the stage. And while we do so, this is where we'll get our speakers to come together and share with us all about navigating climate finance transition. And this session will be spearheaded by Shalabh Tandon, Regional Head of Operations and Climate Change, IFC South Asia, World Bank Group. We often say that to get the right answers, one needs to ask the right questions, which is why we are in the able hands of Mr. Shalabh Tandon as he extracts relevant insights from his fellow speakers. Meanwhile, once again, I'm going to urge our members of the audience to keep those conversations coming using hashtag PlanetBuddy, and please do so by also tagging GSA. Let me please invite our session moderator, Mr. Shalabh Tandon, to please come on stage, sir. And may I also please invite our panelists, our speakers joining in for the discussion. We have with us Ashwini Kumar Tewari, Managing Director and Board Member, Corporate Banking and Subsidiaries, State Bank of India. We also have with us Srini Nagarajan, Managing Director and Head of Asia, British Investment International Group. Ladies and gentlemen, we are talking about a finance dialogue. Can we have a wealthy round of applause, everyone? Please help me welcome our befitting leaders here who have joined us at the SDG Summit. Thank you so much for joining us. And with that, let me quickly hand it over to Mr. Tandon. Over to you, sir.
Thank you, and it's a pleasure to be here, and welcome to my colleagues Ashwini from State Bank of India and Srini from BII. As we heard in the morning session and earlier sessions, the NCQG is going to be at the center of the COP discussion. How do you really scale up climate finance flows into the countries? So with that, let me open up with my question. My request is let's try to be brief in the responses so that we can cover as much ground as possible. And let's try to make it interactive. So if I ask a question to Srini and if you want to respond and add to it, please feel free to do that. Let's make it interactive. So my first question to both of you is, maybe you can take a minute or two to give an overview of where do you think the current state of play on climate finance for India is concerned, and where is the biggest gap and challenges that you see from your vantage point or your institution? And then we'll get into more discussions around this. Also in the morning session, just for the context, a number of C's were discussed that are critical, like commitment, consistency, collaboration, etc. Let me add two more C's to it, which our session can delve into. One is catalytic capital, and the other is capital markets. So as I'll question both of you later on, we'll delve deeper into these two. So with that, let me start with you, Ashwini.
Thank you, Shalabh. Good afternoon, everyone. We are a little delayed in the sessions, but I'm very happy to be here at the Global Sustainability Alliance. And one good thing once one come here in summits like this is to meet so many interesting companies and people with whom we can interact and help in this entire climate finance piece. Because while we have the money, we don't necessarily have the clients in this area, viable clients. So therefore, in terms of overview of the climate finance sector, I would say everybody recognizes the need is humongous. In fact, a McKinsey study estimates this till 2070 at $10 trillion. There are various estimates which Niti Aayog is now trying to collate to come to a reasonable number. But there is a near-term target of 2030, which again requires, some say, about $200 billion investments every year. So the size of the requirement is huge. And this is just in terms of transition. We are not even talking about the adaptation part of it, which is not getting the attention which it probably needs. And that is getting flagged as part of maybe if there's a flood or if there is any other natural disaster. So in terms of disaster recovery and management, that is where the adaptation finance is actually going. So as a bank, for example, we are very active in the renewable energy space, which has gotten commoditized over the last 5-7 years, especially in solar and wind and small hydro. And therefore, we have built up quite a good book for ourselves. But we recognize that building up a $6 to $8 billion book, which is the current outstanding, is nothing compared to the need which India has, even in these segments which we talk about. Good thing is for solar, for wind and hydro, there is no dearth of capital, including bank capital. There is enough equity interest. There is enough interest from outside. It is the other segments as we go down that chain, whether it is the manufacture of equipment related to solar. Again, it's very early, though PLI is helping. or is it the battery energy space and the transmission energy? Because now with solar scaling up, the need is to actually build up transmission. So these are the areas where I think the engagement has to happen, and we need newer companies. And again, coming to multilaterals, because that's again such a key piece of all the conversations we've been having. The thing we request them is for blended finance and for expertise, not necessarily for the money as such. Last thing I would say is the need is for a large amount of guarantees or instruments like guarantees, either from the government or from multilaterals. A good example is the emergency line of credit, which was given to MSMEs during COVID, which helped save so many industries. And at the end of it, now it's ended and the repayment is almost ending. Like the SECI's help for the solar thing in the beginning, I think we need instruments like those to come up and make it commoditized so that banks, which are conservative by nature, are able to fund a large and at scale, which is what is needed.
Thank you, Ashwini. Srini, would you like to add to that perspective?
Sure. So I work for a development financial institution, which is the world's oldest, called, we used to be called CDC. I think if you look at, I work across Asia, so I have slight privilege of looking at other markets, but I must say that, look, India is pretty advanced in terms of the policy environment and also the track record of investors having delivered value. If you look at many Southeast Asian, I'm only talking emerging markets here. So India is, when I look at in comparison to other markets, the other markets have a lot to learn from India. That's number one. Number two, if you look at the whole climate story, it has got three components. It's got the net zero by 2050. It's got the just energy transition program. India is still to implement a JETP. Many countries have. You've got adaptation and resilience. So these three, if you have to address, you need different forms of capital. A simple form of growth capital will not do. What you need in the world of climate finance is two things. One, if you look at, I'll explain that. What you need in the world of climate finance is two things. One is about the fact that you need, a kind of catalytic capital to make sure that you're able to invest in enterprises where commercial capital is nervous of going, right? And that's the role of a DFI like IFC and BII, where we don't want to crowd in. We don't want to crowd in. We don't want to crowd them out. So that's where the catalytic finance is very helpful. So once you bring it to a commercial stage, then of course there's a ton of money available. Now, we can definitely talk about blended finance, which is a very, very vital and important topic, which all of us are working on in a big way. So mobilization and blended finance are the two important tools in which you can try to scale this up. Finally, on the climate tech side, we invest in a lot of VC funds. The problem is that I think there's still not much money has gone into in the whole climate tech area, because the tech investors look at climate tech through the lens of technology alone. But these are capital intensive businesses and you need patient capital. So I think DFI money should go more into the climate tech area so that it's able to provide that patient capital. And there is a value of death between this as far as success rates are concerned.
So Srini, thanks. You raised a number of interesting topics here. Let me delve a little deeper into the blended finance, which Ashwini also raised. So I've been at many different panels and this blended finance keeps coming up and up. And there's still, I think, a lot of confusion as to what government views as blended finance, what private sector really views as blended finance. Is all money from DFIs blended finance or not? Is blended finance only free money? So can you elaborate from your perspective, what are the blended finance instruments that will be most useful for a country like India? And how do we prioritize it? I think the earlier session also talked about somebody, I think Sumit from BCG talked about having a bang for the buck. How do you prioritize? Where do you think would be the most efficient use of blended finance? And maybe Ashwini, from a demand perspective, you do a lot of lending. How do you see the same state? Let me start with Srini and then I'll come to you.
Sure. I'll keep this quick. I'll give him more opportunity to speak. So as far as blended finance is concerned, the way we are conceptualizing it, it's got three strands. Number one is, the way we are looking at Asia is about making sure that there is an energy transition mechanism, which we are working jointly with ADB in terms of foreclosure of the coal plants. Second one is marginally bankable into bankable. That's another area. The overall concept of marginally bankable is still very much there. And the third one is about greening as far as greening industrial transformation is concerned. We talk about green steel or green cement, etc. The reason why blended is very useful here is commercial investors are very nervous of coming and they may not make the returns So blending has got three layers. One, you got the concessional pool, then you got the DFI pool, and you got the senior pool. Normally, if you take $1 billion raise, at 20 odd percent will be concessional, 30 odd percent will be DFI pool, and 50 odd percent will be senior. Blending is very necessary for two reasons. One is, I think there are lots of climate concepts which are still at an evolution stage. Indian capital markets, it's very evolved, but if you look at InvITs today, it's still under-involved. To raise InvIT for a renewable energy company today is not that simple. Not many anchor investors are willing to come and take that risk. I think DFI capital can play a role. So a lot of evolution of concepts in climate which does require blended finance. And the second important reason here is world of philanthropy is only investing 2% into climate as of 2022. Last year it could have been higher and this could have been higher. I don't have the numbers. But imagine 2% of philanthropy money coming into climate when climate is a burning issue, as the panel spoke. I think there is a greater scope for DFIs like us to bring in the philanthropy money into the mainstream climate and blend it properly.
So I've been in many forums where DFIs have been bashed of not providing enough blended capital. But let me give the floor to Ashwini as to what do you think what is your ask on blended finance?
So again, this is not a new topic. As very rightly explained by Srini, blended finance or philanthropic capital is needed for that risk part, which is not easily estimable by the commercial entities like ourselves. And therefore, to that extent, if we are not going to fund it otherwise, if they come in and take that loss absorption capacity, that is to that extent blending is required. Coming to DFIs, I think one of the things is that extremely important to have that DFI element and the other philanthropic element. But what we are seeing is that the rules of engagement have not changed. So while the climate is the recent thing and more popular these days, every DFI wants to support that. We sometimes request one of the leading DFIs active in India to, why do you still need a sovereign guarantee? Is the sovereign-backed bank not good enough, which has never defaulted? But that has not changed. And while guarantee is one part which we can still leverage, but the cost of that, which is to be paid to the government or any other entity, actually that adds to the overall cost. And I think these are some of the things, or a limitation on that you have to use this money in the next 2 months, 3 months. I think these are some of the irritants, if they go away, will go a long way in terms of how DFIs funding can be quickly integrated into climate, as because much of the technology is still evolving and we want the best technology at the lowest cost in India.
I read that SBI is looking at a lot of screening when it looks at all the lending. They do a lot of climate risk assessment, both physical, transition, etc. What is the state of play? And since SBI is one of the largest banks here, a lot of the banks will look up to you, how you roll out all these products. So what is the state of play? And if you can also link up with the recent government announcement on at the budget on having a climate taxonomy. So what role is SBI playing in all this?
So we are working with both government and the regulator on all of this. In fact, the risk scenarios which the Reserve Bank of India put out earlier this year, which have to come into effect from next year onwards, where every bank has to do a climate risk assessment of its portfolio and report to the Reserve Bank, which will then advise whether some buffers or provisions, etc., have to be created. Now on the climate taxonomy, this is a request which we have been making to both regulator and the government. Thankfully, the government announced, and hopefully in this next 1 year, this should be in place, because that's very, very important to welcome or to bring in external money. It has to be measurable and on the same parameters. So that's one point. As far as we are concerned, actually, we are the only bank in the country which has set up a separate climate finance unit and a separate climate risk unit as part of the risk department. And this is not only devising best practices in this space. Ourselves, for our portfolio, we are currently measuring the Scope 3 emission for ourselves. And we are working with many of our clients to see what we can fund them, so that at a concessional price, so that the overall emission comes down for them. The leading ones all have their plans, but we are trying to understand what those plans and can we come in on those. But there is a large chunk of MSME, and we have a very large book of MSME where there is no plan as such for any kind of a climate thing, because they are part of supply chains. So again, we are trying to work with them and see, can we devise simple products for them, which will bring down their emissions. And to at the beginning, at least let them start measuring the emissions.
Yeah.
And without which actually there is no play as to whether what has come down or not. So we are doing a lot of things, but this is an industry thing. It's not only we alone which will be doing it. So we are working with all the other banks through the Indian Banks Association and with the RBI to actually take it forward. Because as somebody said earlier that बातें बहुत हो चुकी हैं, it's time for action. So we are trying to do that in an understated manner. We do not want to claim a lot of credit till things get done. But I believe a lot of things are getting done, because if we talk more about it, ultimately it translates into action, which is starting to be seen.
I think, and you're right about supply chain finance, because a lot of the scope 3 emissions are there, and that's very hard to abate. So I think Srini, BII has some partnership with ADB and others on supply chain finance and really scaling it up.
I'll just add one small point.
Yeah.
We have a lot of lines from multilaterals. Now we are passing all the benefits of that interest rate, tenor, etc., to all the corporates which are trying to do work in this area. So it's making a real difference, because we don't get 20-year dollar money anywhere else. Nobody else in India is able to raise that easily. So we are trying to make it available direct through. We're not keeping any margins for ourselves, because we believe that this is a long-term capital which must be made available for climate transition.
So Srini, on supply chain finance, if you want to add something.
This is a product which we use our balance sheet very effectively, both from a trade finance perspective and also the risk sharing which we do with commercial banks. This is very critical from the point of view of making sure that different sections. See, one of the problems is that inclusion and sustainability have to go together. When you think about sustainability, inclusion can be easily forgotten. And we can't do inclusion ourselves, institutions like IFC and us, because these are smaller transaction, execution challenges are high. So we go through an intermediated route, either in the form of directed lending to commercial banks, which the money can be used for climate, or we do the trade finance lines with various commercial banks. So I think this is a very important route for us to reach the SME sector, so that as DFIs, we don't forget the SME sector, because inclusion is very much at the heart of what we do.
Thanks. I think also the hard to abate sectors, we touched upon that, like manufacturing, steel, cement, etc. These are very hard to abate, and they need many different technologies, new technologies, hydrogen, and so on. What are both of you institutions looking at doing for hard to abate sectors in terms of either products or advisory or technology innovations, whatever it is? Because unless that happens, India's path to net zero will still face challenges.
Yeah, so we understand that different companies in India are at different states in terms of hard to abate sectors. For example, in the steel sector, we have a couple of companies which are very high up. They have gone a long way, and they have internal targets to actually reduce the emissions from maybe 120 tons per ton of steel to 80 or 90, much below. But these best practices are not known to the rest of the middle level scale companies. So we are doing sectoral workshops and where we get these best companies in the field to share as to what they are doing, try to see whether we can incorporate those learnings, and then get the middle level which are not able to get that expertise into that pool, and also help them with funding if required, so that they also get where they are.
Are you into sustainability linked loans and bonds, and have you started doing that?
Yeah, we have raised some loans on that count, and we are passing on those benefits to others. But again, this is a still work in progress.
No, we do subscribe to those bonds, sustainability linked bonds, jointly with IFC and other. And also we are the only DFI in the country or in the world which establishes subsidiaries. We have a largest IPP in Africa called Globalac. We have a T&D platform called Gridworks. India, we started Ayana, which has got 5 gigawatts today. So through them, energy storage is the way to go. I think once we are able to, we are investing a lot in energy storage, trying to find ways and means of how we can reduce the cost, either through pump storage or batteries. And that's the way to go in future.
But are you pump storage and battery? That's interesting. But are you also bullish on green hydrogen?
Yes, we are.
And what about you? Are you?
So we are looking at it, because it's still 6x.
I think this is a.
We are a conservative institution,
Yeah,
so
yeah.
we
I think
can't.
I've heard that phrase a lot of times. We are looking at it.
Shalabh, you and I are probably one stage before State Bank can come, because we can take the early stage risks.
Yeah, I think we are running out of time, so let me try to squeeze in one last question. I'll add one more C to the equation, which is the carbon market. There's a lot of discussions about carbon markets, especially for carbon dioxide removal and so on. What, in your view, should India be doing? Will carbon markets really make a difference? Or will it be at the margin? If it makes a difference, where should it be focused on? What should India be doing? If any of you have views, happy to
I mean, as far as our view on carbon markets is concerned, the voluntary carbon market is still evolving. It's not yet there. If you base your entire revenue model based on that, it's not stacking up, I'll be honest with you. We need an alternative revenue model based on that. I think countries are, I mean, beyond India are also protective about some of these things, export of these. So it's still some distance to go. Nature-based solutions is a very important part of climate change.
Yeah.
And we have to work towards this. And voluntary carbon markets are an important component of this. But unfortunately, it's still, the industry is still very, evolution stage. That's probably where you need more blended finance.
So my view is that first of all, the regulations have to be clear, and we are still evolving in that. But I think India is a large country with such diversity in population, regions and everything, needs all solutions. And therefore, carbon markets are also important for us because we have a large part of the country that doesn't emit at all or very little. So they should be able to get some benefit if they can from these kind of markets. So I think we do need this. But as she rightly said, we come a step behind you. So we'll wait and see how this evolves as well.
You are being humble. You are not always a step behind us, but when you jump ahead of us on many different things. But thank you very much. It was a very interesting talking to both of you. Thank you.
Thank you, Shalabh.